Welcome to Money Made Simple. Today we're covering Index Funds Explained for Complete Beginners. This video is for educational purposes only and is not financial advice. Always consult a qualified financial advisor. Did you know that trying to pick individual winning stocks is incredibly hard? Even for the pros? In fact, most professional fund managers fail to beat a simple market index over the long run. This means you don't need to be a stock market wizard to grow your money. Today, we're talking about index funds, the simplest way to invest and potentially build significant wealth. This strategy allows you to participate in the market's growth without the headache of stock picking. Imagine you want to invest in the US economy, but picking just one company is risky. An index is simply a list of companies, like the S&P 500, which tracks the 500 largest US companies. An index fund is an investment that automatically buys a tiny piece of all the companies in that list. So, instead of trying to pick the best apple, you buy a whole basket of 500 different apples. This gives you instant ownership in a broad slice of the economy. Your actionable step for today: understand that an index fund is a basket of many stocks. Index funds make you money by simply mirroring the overall market. When the companies in the S&P 500 generally grow and become more valuable, your investment grows too. You don't need to worry about one company failing because you own tiny pieces of hundreds of them. For example, if you invested $100 a month into an S&P 500 index fund, historically, it could grow by an average of 8 to 10% per year. That $100 a month could turn into over $150,000 in 20 years. Thanks to the magic of compound interest. Your actionable step for today: realize that market growth, not stock picking, is your friend here. Index funds are fantastic for three main reasons. 1. Simplicity. You set it and forget it. No research needed. 2. Diversification. You automatically own many companies, reducing risk if one company struggles. 3. Low cost. They have very low fees, called expense ratios, because there's no expensive manager trying to pick stocks. For example, a typical S&P 500 index fund might cost you less than $10 a year for every $10,000 invested, while actively managed funds can cost $100 or more. Your actionable step for today: consider the simplicity, diversification, and low cost as key benefits for your investing journey. Ready to dive in? Your first step is to open an investment account. Think of it like opening a bank account, but for your investments. Reputable places like Vanguard, Fidelity, or Charles Schwab are great for beginners. They're user-friendly and offer a wide range of index funds. You can typically open an account online in less than 15 minutes. Your actionable step for today: visit Fidelity.com, Vanguard.com, or Schwab.com and start the process of opening an individual brokerage account. You don't have to fund it immediately, but get the account open. Once your account is open and you've linked your bank account, it's time to choose an index fund. For complete beginners, we recommend a broad market index fund, like one that tracks the S&P 500 or the total US stock market. Common tickers to look for are VOO, SPY, or IVV for S&P 500, or ITOT or VTI for total US market. You can literally buy as little as $50 or $100 worth. Some platforms allow fractional shares, so you don't need to buy a whole share that might cost hundreds. Your actionable step for today: fund your new investment account with as little as $50 and place an order to buy shares of a broad market index fund like VOO or VTI. Even with simple index funds, there are pitfalls. 1. Don't time the market. Don't try to guess when prices will go up or down. Just invest consistently, rain or shine. 2. Don't panic sell. When the market goes down, it feels scary, but resist selling. History shows markets recover. 3. Don't overanalyze. The beauty of index funds is their simplicity. Don't get caught up in daily news or minor fluctuations. Your actionable step for today: commit to investing regularly, e.g., $100 every month, and resist the urge to check your balance daily. Let it grow. Index funds are a simple, low-cost, and effective way for beginners to invest in the stock market and build wealth over time. You get instant diversification without needing to pick individual stocks. Start today by opening a brokerage account, buying a broad market index fund like VU or VTI, and committing to consistent investing. Remember, consistency and patience are your best friends in building wealth. This video is for educational purposes only and is not financial advice. Always consult a qualified financial advisor. That's everything for today's video on index funds explained for complete beginners. If you found this helpful, please like and subscribe. New finance tips every week on Money Made Simple.